You open your brokerage app. Your hands are shaking a little, not because something went wrong, because something went right. Your portfolio is up $200 today. $200. And you feel like you just discovered fire. That's where it starts for every single person. And if you stay in this game long enough, you'll look back at that moment and laugh. But right now, that $200 feels like the whole world. This is your life at every single level of stock market experience. Level 1. You don't really know what you're doing, and that's okay, because nobody does at the start. They just won't admit it. You heard about stocks from a friend or a YouTube video, or maybe your uncle kept talking about how he made money on Tesla, and you thought, why not me? So you download Robinhood, you fund it with $500, and you just stare at it. The first thing you do is buy a stock you recognize: Apple, Amazon, maybe Tesla because your uncle won't stop talking about it. You don't analyze anything. You don't look at earnings. You buy it because you've heard of it, because you use the product, because it feels right. That's your entire strategy. Vibes. And here's the scary part. It works. First, the market goes up, your stock goes up, and you think you've cracked the code. You think you're good at this. You start checking your portfolio 15 times a day, before breakfast, during lunch, in the bathroom. You refresh the app like it's going to say something different in 30 seconds. Then one morning you wake up and your stock is down 8%. No warning, no explanation on the news, just red, pure red. Your stomach drops. You don't know if you should sell or hold. You Google, should I sell my stock when it goes down? You get 40 different answers and none of them help. You make your first real mistake here. You panic. You sell. You lock in the loss. 3 weeks later, the stock recovered fully. You would have been fine. You just didn't know that yet. This is the most expensive lesson in investing. Emotions cost money every single time. You buy another stock. This time you've done a little more research. You watched a few YouTube videos. You learned what a PE ratio is. You feel smarter. You're still guessing. You just feel better about it now. Level 2. Something changes around 6 to 12 months in. You stop being impressed by your own wins. You start actually thinking about why a stock moves. You find a strategy. Maybe it's dividend investing. Maybe it's growth stocks. Maybe someone on Reddit convinced you to try swing trading, and now you're staring at candle charts at midnight. You open a second account, a Roth IRA. You start reading about index funds. You discover Warren Buffett quotes, and for about 3 weeks, you feel like a philosopher. You start a spreadsheet, multiple tabs, color-coded. You track your cost basis, your gains, your losses, your dividend yield. You've become someone who has a spreadsheet. You didn't see that coming. You also discover CNBC, and at first you take it seriously. You watch the analysts debate. You start making trades based on what they say. Then you notice something strange. They're wrong. A lot. And they just move on to the next prediction like nothing happened. You stop watching CNBC. Now you're doing your own research. You read earnings reports. You learn what revenue growth means, what gross margin means. You learn the difference between a stock being cheap and a stock being undervalued. These are not the same thing. You lose money on a company that has great fundamentals. Everything looked good on paper, but the CEO made a weird comment on the earnings call and the stock dropped 20% in a day. You realize that the market is not just math, it's psychology, it's an emotion. It's sometimes completely irrational for months at a time before it corrects. This phase is where most people either quit or get serious. You get serious. You start building a real portfolio, not random picks, a real allocation. Some index funds, a few individual stocks you've actually researched, maybe a small percentage in something higher risk because you're not perfect. You have your first year where your portfolio beats the S&P 500. You're proud. You tell a friend. Your friend doesn't fully understand what the S&P 500 is. You explain it. They nod politely. You also have a year where you underperform. The market goes up 10%.
You went up 4. You did everything right and still fell behind. That one stings differently. Losing money is one thing. Losing to an index fund that requires no effort at all? That's humbling. But you don't quit. You adjust. You read more. You try less. You start hearing a phrase repeated everywhere. Time in the market beats timing the market. You resist it at first because it sounds too simple. Then you look at the data, and you realize the most boring strategy is often the most effective one. You start automating your investments. Every payday, money moves into your brokerage account automatically. You barely feel it, but month after month, year after year, the number grows quietly in the background while you live your life. You've stopped checking your portfolio 15 times a day. Now it's maybe twice a week, sometimes less. That is actual progress. That's not just knowledge, that's emotional discipline. And in this game, that's worth more than any hot tip.
Level 3. You've been doing this for a few years now, and something has quietly shifted inside you. You don't get excited about green days the same way anymore. You don't panic on red days either. The market goes up 5% in a week, and your friends are texting you saying this is insane, and you're just calm. Not because you don't care, because you've seen this before, multiple times. You understand cycles now, not perfectly. Nobody understands them perfectly, but you recognize the patterns. You know what a bull market feels like when it's getting too confident. You know what a crash feels like in the early stages, the weird quiet before the volume spikes. You've lived through at least one real downturn now, not a dip, an actual sustained drop where every single week the news is telling you the world is ending. And you didn't sell. You bought more. That decision, holding and buying during a crash when every instinct says run, that is the moment you graduate from intermediate to advanced. Because it takes real experience to do that. You can read about it 100 times, but doing it when your portfolio is down 30% and the headlines are terrifying, that's a different thing entirely. You've also learned what you're not good at. This is underrated. Most people spend years trying to master every strategy: options trading, forex, crypto, futures, technical analysis, fundamental analysis. They become average at everything and excellent at nothing. You've narrowed your focus. You know your lane. Maybe you're a long-term buy and hold investor who runs a concentrated portfolio of 20 stocks. Maybe you've built a dividend income machine that throws off cash every single month. Maybe you've gotten good at identifying small-cap companies before they grow. Whatever it is, you know what works for you specifically. Not for the guy on Twitter, not for the podcast host, for you. Your portfolio is real money now, not life-changing money yet, but real. Enough that a bad month actually matters. Enough that you've had a genuine conversation with yourself about risk tolerance and actually meant it. You start thinking about taxes, not as an afterthought, as a strategy. You understand tax loss harvesting. You know the difference between short-term and long-term capital gains. You're maxing out your retirement accounts before touching your taxable brokerage. You've realized that the return you keep after taxes matters just as much as the return you earn. You've also stopped taking financial advice from people who don't invest. Your brother-in-law tells you to put everything in gold. Your coworker says crypto is going to replace everything. You smile, you nod, you do nothing different. People start asking you for advice now, and you've learned to be careful here because what works in your situation, with your income, your timeline, your risk tolerance, might be completely wrong for someone else. You give general principles. You tell them to do their own research. You recommend a few books. You don't tell them what to buy. You've also had a significant loss by now. Not a small one, a real one. A position you were confident in that went to zero, or close enough. A company you researched thoroughly, believed in completely, and watched collapse anyway. That loss didn't break you, but it taught you something no book can teach.
that confidence and correctness are two completely different things. You can be fully convinced and still be wrong. The market doesn't care how certain you feel. That lesson made you more humble and, paradoxically, more effective.
Level 4. You look different to other people now. Not in an arrogant way, just in a settled way, like someone who has stopped trying to prove something. You don't talk about stocks at parties anymore, not because you're hiding it, because you've learned that most conversations about investing are really just people looking for validation on decisions they've already made, and you're not interested in that game. Your process is clean, repeatable. You have criteria for what you buy, and you don't bend them. If a stock doesn't meet your criteria, it doesn't matter how exciting the story sounds, you pass. You've trained yourself to be bored by hype. Hype has cost you money before. Now, boredom is a feature, not a bug. You think in probabilities, not certainties. You never say a stock will go up. You say the probability favors upside given these specific conditions. You hold that position appropriately sized for the uncertainty involved. If you're wrong, the loss is manageable. If you're right, the gain is meaningful. You've built a system where being right 55% of the time still makes you wealthy over a long enough period. Your portfolio has compounded to a number that genuinely changes your life options. Not necessarily a yacht, but real freedom. You could take a year off work and be fine. You could absorb a major unexpected expense without financial panic. You could retire earlier than most people around you if you chose to. You've started thinking about wealth differently. Early on, you thought about it in terms of numbers. Get to 100,000, then 250, then a million. Now you think about it in terms of what it produces. Monthly cash flow, annual dividends. The system works while you sleep. You understand something now that sounds simple but took years to truly feel. The goal was never the number. The goal was options, the ability to say yes to things you want and no to things you don't. Money in that context isn't a scoreboard. It's a tool for designing your life on your own terms. You mentor someone younger, maybe informally, a cousin, a new colleague, someone in an online community. And when they ask you the question you used to ask, what's the best stock to buy right now, you give them the same answer every expert eventually gives. It depends entirely on you, your timeline, your goals, your ability to handle loss without making emotional decisions. Figure that out first. The stock picks come second. They're slightly disappointed by that answer. You were too once. Now you know it's the most valuable thing you could tell them. Here's what nobody puts in the headline. Here's what the thumbnail doesn't show you. The beginner thinks the goal is finding the right stock. The intermediate thinks the goal is finding the right strategy. The advanced investor thinks the goal is building the right portfolio. The expert knows the real goal was never any of those things. The real goal is building a relationship with money that doesn't control your emotions, doesn't steal your sleep, and doesn't make your self-worth go up and down with the market. Every level teaches you something the previous level couldn't. The beginner learns that the market is real. The intermediate learns that emotion is expensive. The advanced investor learns that discipline compounds just like money does. And the expert learns that the finish line was never a number. It was a variant of yourself that can look at any market condition, any red day, any crash, any bull run, and stay completely, quietly grounded. You started this journey checking your portfolio 15 times a day, hands shaking over a $200 gain. You'll end it barely checking at all, not because you stopped caring, but because you built something that works without your anxiety running it. That's the whole game, right there. And the fact that you're watching this video means you're already somewhere on that path. Most people never even start. Keep going.